CNBC TV18 and CNBC Awaaz present the REIT Connect in partnership with IRA.
Hello and welcome to the show, to the special offering REIT Connect, where we explain to you all the tenets and aspects of real estate investment trusts and how it can be part of your diversified investment portfolio. And let me welcome on the show Karan Bhagat. He is the MD and CEO of 361. Karan, always a pleasure to welcome you on CNBC TV18. Now, my first question to you. REITs are a newer asset class. How do you see its potential and how do you feature this in a diversified portfolio? What are your thoughts on that?
Thank you, Nisha, for having me on CNBC TV18. I think REITs are a very interesting asset class, and especially from a portfolio allocation perspective, given the change in debt taxation in the last budget, REITs have become especially attractive. All fixed income mutual funds are now taxed at marginal tax rates. REITs, however, continue to have a slightly preferred tax because the tax is already paid in the special purpose vehicle before getting distributed to the clients. So if you compare it to the 10-year GSEC, today our REITs are giving us around about 5.8 to 5.9% on a post-tax basis. So for a client, effectively, he's getting four things. One, he's getting 5.8, 5.9% on a post-tax basis. Second, he's able to allocate and take advantage of the capital appreciation in commercial real estate over the next 10 to 15 years. Thirdly, he's able to take advantage of the fact of increase in rental over the next 5, 10, 15 years. And lastly, he's also able to take benefit of the fact there is a multiple set of properties lumped into one. And as occupancy increases from the current yields of 80 to 83% to 100%, that benefit would also flow into the REIT. So overall, I think the 5.8 to 6% can move towards the 9 to 10%. So it's nowhere close to an equity alternative. It definitely does not substitute equity in a client's portfolio, but it's a very, very interesting part of his fixed income portfolio, which can potentially end up giving 8 to 10% post-tax over the next 3 to 5 years.
It's interesting you said, Karan, that it's not as good as equity or not at par with equity and more considered as a fixed product. But I would say that internationally, globally, where it's a much larger asset class, it is classified as an equity product, barring the dividend distribution, which is mandatory on the companies. But Karan, if you really compare this with investment in other property asset classes like a real estate company's stock or else a property investment, how do you rate REIT vis-a-vis them?
So maybe, Nisha, I'll correct myself a little bit. I don't think it can be compared to equity. So I think the risk reward is really very, very different because a REIT by definition has a yield distribution of approximately on pre-tax 7/4, 7/2. Obviously, when you buy a stock, you're subject to slightly much more volatility and you're seeking higher returns from a growth perspective. So from a REIT perspective, I wouldn't compare it to stocks. But overall, I think both have their place in the portfolio. I think most of our large high net worth clients today would have 50 to 60% of their portfolio in stocks and still would have around about 30 to 40% of the portfolio on the fixed income side. Within the fixed income side of 30 to 40%, I think REITs offers a serious alternative to be around 15-20% of that 40%. So effectively, for most clients today, REITs would make up close to 5 to 10% of their portfolio. We only have 4 listed REITs in the country, but as the sector becomes deeper and wider, I think this allocation will move from 5% towards 10-odd%.
Right. So how do you see the potential going forward, Karan, for this particular asset class? You said it's only 5 to 10%, and obviously it is only in the commercial real estate segment. We haven't even touched on the residential side and other subsets of real estate, which are really growing in a meaningful way. So how do you see the potential going forward in this? And your company also has a license for REIT. What are your plans for that, given the potential outlook that you have?
So I think overall, the potential for REITs as a broad asset class continues to be fairly large. I think globally, apart from having REITs on the commercial side, even housing, real estate, residential housing REITs are very, very popular and extremely large. Apart from that, you've got co-living REITs, you've got hostel REITs, and so on and so forth. I think generally speaking in India, residential real estate prices have always been slightly on the higher side for the right set of reasons. And therefore, the yields on the residential apartments continue to be tad lower at 4 to 5% as compared to commercial at 7 to 8%. So I think once kind of there is a little bit of more stability in the rental yields on the residential side, you'll see some of them converting into REITs. I think it's not a question of if, it's a question of when. So eventually it will happen. Whether it happens over the next 12 to 18 months or the next 24 to 36 months is something which time will tell. But overall, I think REITs will grow across all of these spaces, whether it's senior living, hostel living, co-living, commercial REITs, or even residential REITs. Commercial REITs, obviously the easiest to understand. And now we've got also a mall REIT, which is listed, which is Nexus. So I think across these 6 broad strategies, you'll see enough increase in the depth and the width of the market over the next 3 to 5 years. On our own side, I think we've got our own REIT license, which we have approximately 12 to 15 months to still decide whether we launch our own REIT or not. So we're still firming up plans there, early days. But over the next 3 to 6 months, we like the space. And if we find ourselves having a sweet spot or a unique opportunity to develop our own REIT, we will definitely look at it.
Right. And in terms of the suggestions, how this can become a more attractive asset class, what would you say? Because on the tax side, it is attractive, but more can be done there. Even equity classification is what the industry is lobbying for. Any suggestions that you have?
I think overall tax has come out well. I think both the regulator, the ministry, as well as the tax department have done a good job. I think it's got to pass through. So the tax is rightfully paid in the special purpose vehicle, and at the recipient's level, it is exempted from tax. So honestly, I think from a tax perspective, a lot has been done. Obviously, more can be done, but a lot has been done. So I'm quite comfortable there. I think one pending demand was really the SEZ's regulation being modified, which too has kind of come in some format or the other over the last 2.5, 3 months. So I think the utilization of the REITs definitely will move up from the current 80 to 83% closer to the 90, 95%, which will also help the REITs. And I think finally, maybe both classification as equity and also more importantly, I think the REITs trade in larger lot sizes. If they can be traded in smaller lot sizes, especially the larger ones, I think it will allow a greater pool of people to access the REIT.
All right, so great suggestions there, Karan. But a quick question before I let you go. What's your view on the market in the near term? Some of the big events happening in election season, interest rate cut, expected geopolitics. How do you see all this really impacting our markets in the near term?
So I think we can't escape from the fact that the markets are slightly expensive on the valuation side. I think if you look at price to book historical multiples for the last 10, 15, 20 years, we are closer towards the 3.5 to 3.7 times as compared to the long-term average of closer to the 3 to 3.2 times. So we are definitely a standard 1.5 standard deviation away from the long-term averages. Having said that, I think generally speaking, if I look at the large cap and the large mid cap space, which broadly would include the top maybe 300 to 400 stocks, as well as some mid-cap stocks which have large institutional ownership. I think these two categories may correct a bit, but they definitely are not going to correct in such a meaningful way that you have an opportunity to get out of equities and get in again. I think broadly FI investors across the world over the last 24 months have under-allocated to India. And especially these two segments, if the market's correct, will get a huge amount of investor appetite from these set of investors. So for these set of stocks, I wouldn't really worry. I would stay invested. There will be a little bit of volatility, a little bit of shocks. Which event will cause it? We really don't know. But I think I would kind of hang in there. On the mid cap side and the small cap side, I think there are again it's very stock specific, but there are excesses there, and that's where I would be a little bit wary. And if there's a deep correction in the market, some of those stocks could potentially correct 15 to 40%, and therefore we need to be very, very careful on which mid-cap and small mid-cap and small-cap stocks we own. But outside of that, from a 5-year perspective, the markets continue to look constructive.
All right. Thank you so much, Karan Bhagat, for joining us right here on REIT Connect. Thank you so much.
CNBC-TV18 and CNBC Awaaz present the REIT Connect in partnership with IRA.